All right. Welcome back to another episode of the Real Estate Investing Club. As always, happy Friday, everybody, bringing that Friday energy. It is nice and sunny here in Seattle, so it is a good day. It's a good day for a second reason because we got Gideon Pfeffer with us from the GSH Group. Gideon is in multifamily, over 7,000 units over the past, I believe, well, I want to say 5 years. You can correct me if I'm wrong on that one, but
Seven
either
years. Yeah, 7 years. We haven't really bought much recently, but yeah.
7 years. Regardless, that's a good trajectory. So, yeah, I'm super excited to jump into this. Gideon, thanks for hopping on the show.
Yeah, Gabe, it's great to be here. Thanks for having me.
Absolutely. I told you before we got on here, we always like to start with stories and hear how people got to where they are. So why don't you take us to the beginning of where you got started in real estate and just kind of tell us how it's gone?
Yeah, absolutely. And I'll try and be brief. So, I got out of school in 2002 and got into residential mortgages,
Mm,
and a buddy convinced me
fun.
to buy an investment property with him with the idea of flipping it. And so we both put in a couple bucks, but we didn't sell it to a homeowner. The idea was let's fix it up, put a renter in it, and then sell it to an investor.
Mm,
And so it worked. We made some money, so we doubled down and we bought two more, and we sold those. Then we bought four more, and it sounds like um, a tall tale, but the truth is we just kept compounding and compounding, and before we knew it, the financial crisis happened. We were able to buy properties for even cheaper, and we were buying and selling 100, 200 houses a year.
oh, wow.
Yeah. So that led me through 2015, 2016, when I felt my wife and I were kind of talking about where we were in life. And that was a great business, great cash, but also a trader business. We really weren't benefiting from the tax advantages or passive income advantages that real estate had to offer. So, how do we take what we've learned over the last decade and convert it into something that'll really pay dividends long term? And we
Mm,
felt that stepping into multifamily and multifamily syndication would be a way where we can earn money, at acquisition. We can earn passive income along the way, benefit from capital growth and appreciation at the end, but also take advantage of tax advantages like accelerated depreciation and long-term capital gains.
nice. So at what point you guys were doing, 100, 200 a year? That is a lot of volume, especially when you're talking about flipping. Um, at what point did you guys switch over, make that switch to multifamily? What was like the first deal that you guys did?
So we that my partner and I that partnership kind of ran its course in 2015, and I did a couple of joint ventures in single family, similar type of stuff. And the first deal in the multifamily side was so I came in contact with a couple other guys along the way, along my journey, who are, a couple decades older than me. One had a small portfolio of multifamily. One had great connections within Michigan, where we live and where we're headquartered. And so I approached them to, um, maybe put together a partnership and go and buy multifamily. And so our first deal was a cute little 64 unit property in Michigan. This is before GSH actually even existed. And I went to them and said, "Hey, I want to buy 10,000 units." And they said, "That sounds great. Why don't we buy one deal and see how it works out?" Right. And so we did that. It worked out well. Everybody did their job. And then we got lucky enough to, on a competitive round on our second deal, we were able to take down a 308 unit
Wow,
um,
it's a big one.
property as our second property.
Yeah.
And then we were kind of off to the races.
Nice, man. I love it. And this was all happening in Michigan?
Originally, it was in Michigan. We started branching out. Our second deal was in Indiana.
Hmm.
We stayed pretty heavy in Michigan, as it is our backyard. But our portfolio is across 6 states today.
Yeah. So I always I had an economist on a bit ago, and he was talking about stickiness of big cities, and he was saying
Yeah.
it doesn't matter what the city is, if it reaches a certain population size, a certain growth, then even if there is a major economic blow to the city, it's going to stick and people are going to stay there and it'll come back. Detroit is one of those cities that has kind of interested me over the years because it had such a major blow with the auto industry. I'm sure you guys have invested there. What have you seen investing there, and um, kind of how has the trajectory of Detroit revitalizing itself occurred within your own investing experience?
It's a great question. Detroit is such a name brand, but also like any other large metropolitan type location or MSA, Detroit is just the city, right? And then there's a surrounding metropolitan area that people don't really realize is in Michigan here, the Detroit metropolitan area is very strong, very populous, and there's a lot of wealth.
Hmm.
So in there's a tri-county area of metropolitan Detroit. There's over 4 or 5 million people that live there.
Mm-hmm.
It's a pretty diverse workforce, not just automotive, even though automotive and ancillary businesses are pretty key. And what I've seen is, I was involved in buying single family houses in Detroit through the financial crisis through 2013 when Detroit declared bankruptcy. Um, and then we had some billionaires from Michigan come in and start investing within the central business district. One in particular, a guy named Dan Gilbert, who owns the Cleveland Cavaliers. He owns Quicken Loans, which is now Rocket
Oh yeah.
Mortgage.
Mm-hmm.
Um, and he came down and took advantage of what went on in the financial crisis and bought up like 100 buildings and created a market there, kind of played Sim City. And it's like night and day. It doesn't even look like it did back when I was living down there. I lived in downtown Detroit from 2002 to 2009, and you'd be blown away the way that it looks. And I think that while we're not super heavy in Detroit proper, we do own some properties down there, but um, it's really improved the idea of the Detroit MSA
Mm.
to people outside of Michigan, which has helped um, as we continue to grow our investor base, right? People have maybe more of an open mind than they did 10 years ago. And it also helps in valuation because as as the market became more competitive through 2019, 2021, and larger institutional buyers were kind of tapped out or having a hard time finding yield on the coasts or in the Sun Belt, more money started flowing into the Midwest, and we took advantage of that with some strategic exits.
Yeah. Yeah. So, I mean that is interesting, and it's interesting to hear people's perspectives who were investing before 2008 and then went through it and invested during the down, during the trough and all the way up.
Right.
People keep saying that that is going to be happening here soon. The yield curve has been inverted for however however many years, and they are always doomsdaying about the coming recession. Having gone through something like that, you invested through 2008. What do you How was your experience back then, and then how do you see what are you doing to prepare for this upcoming, if it does happen, major recession?
So my experience was very different back in 2008. I was 28 back then. I was doing real estate deals, but not at the level or enterprise that we have today. Um, but the second part of your question, as it relates to like what are we doing to prepare? I mean, we're trying to educate our current investor pool as well as folks who are interested in potentially getting involved in real estate or real estate syndication to not be fearful, right? Like real estate is cyclical, which means that cyclical sounds like round and round, but basically it goes up and it comes down. It goes up and it comes down, right? And so um, pre 2008, pre financial crisis, there was a bubble. It ran up. It was really good. People made a lot of money, and then values shot down. And in this cycle, it's a little bit different. But interest rates were historically low. There was a ton of equity in the market, and it drove prices up, up, up. And as soon as interest rates went up, and they went up at an alarmingly fast rate and an unprecedented rate,
This was
it
in
dropped.
2008.
excuse me, in the news cycle now here in
Oh, right. Yeah, yeah.
2022, right? As in 2022, as interest rates went up so high, that caused a lot of distress as well. And I think that people got, I've experienced and spoken to a lot of investors who are a little gun shy, right? They were investing from literally 2012 to 2020 for 8 years, and as a real estate owner, you could hardly do any wrong. Like you had to be pretty not great to lose money in during that time period, and people got used to everything going well. Now we've seen operating expenses go up because of inflation. We've seen just a different dynamic in the landlord-tenant relationship, and maybe delinquencies going up a little bit more, occupancies going down a bit. And so you see investors getting a little bit fearful of new investments, making new investments. And I believe that in the coming years, and whether it's 12 months, 24 months from now, we're going to be in probably the best buying opportunity we have been in a decade based on value, based on where interest rates are and where they probably will go, which is down a bit, which will increase values automatically. And I'm hopeful that people don't let you know more recent deals that maybe aren't going as planned, keep them away from taking advantage of what's coming.
Yeah. Um, it is very easy, especially I haven't, lost money on a deal yet, knocking on wood. But I have had deals not go the way that I expect them. Every deal goes a little bit different, but some of the deals, one of the deals that I went into particularly, um, it was a kick in the face. We still made money, but not as much as we thought, and it was just it was a very difficult deal to run. So when you have that kind of experience, and especially if you were to lose money, it is so easy to want to not do it, to feel like you lost your game, or feel like you just don't have what it takes, or whatever the feeling that you have, to not want to continue into real estate. But I feel like that's a good message to get out there, because um, one deal does not define your career, and it doesn't define what will be happening in the future, especially when there's an opportunity on the horizon. If something happened in the recent past that maybe you didn't do as well as you could have on a deal, don't let that stop you. And I feel like I'm just kind of reiterating what you said there, because I feel like that is a good message, and it is hard to get off of a bad deal, even though bad deals happen. It's going to happen to everybody, but you just got to
And
keep going on it.
I think that if people can remember that most investments are best long term, right? The stock market may go up, it may go down, but long term it's consistent. Real estate's the same, right? And so if you're playing the long game with your real estate portfolio, whether you're buying directly or investing with sponsors, you're going to have wins and losses. But over the long term, if you stay in the game, your wins will outpace your losses. And so if you've had some, whether it's a loss or not a loss, or things not going according to plan recently because the market shifted, we're about to enter into a time period where you can spread your basis out, and you can win, if that makes
Yeah.
it right. Like, so we just went out of a time where, using simple words, that it was a loss. Now we're about to enter into times that's a win. Don't let your losses keep you away from going after some wins.
Yeah, I like that. So speaking of the next, couple of years, what does it look like for you guys? What's your current investing strategy? What are you going after? What's the goal in the near future?
So right now we're underwriting a ton of deals, and we're having a hard time finding existing projects that pencil out to returns that make sense to us. There's still kind of this disparity between what sellers want and what buyers are willing to offer. I think that that's going to change. There's going to become more of a need for sellers to sell as time goes on in the short term. So we're keeping an eye open for that. Right now we're trying to create opportunities through new construction and development. Um, we have a new construction project that's just wrapping up here in Michigan, in Lansing, which is the capital of Michigan and where Michigan State University is. And we've got another project in a very affluent community here of Grosse Pointe, Michigan. We've got our own construction company. And so we're looking for kind of design build opportunities where we can kind of create product in the meantime while we wait for existing product to open up.
Nice. And when you're buying existing, what are you guys? What is the number or the return that you're expecting? Are you guys buying on a cap rate basis man, I do not have my words this morning.
Like
What are
or
you
just
looking for
return.
when you purchase? Yeah.
So I've never been a cap rate buyer. And what
Okay.
that means is that um, there's always a story, right? So like a going in cap rate is tied to current performance, current owner's way of working the deal or managing the property. And if I were just to turn down every low cap rate that I saw, I might miss out on a story that actually could yield an opportunity. So we're looking at what is the average cash on cash return over the hold period, right? So are we going to hold it for 3 years, 5 years, 7 years, 10 years? What's that average cash on cash return? Which a lot of our investors like. They like that ongoing cash. We're having a hard time seeing any real significant cash on cash yield in the first few years right now on deals that we're
And
seeing.
what is the cash on cash that you're generally trying to shoot for?
Somewhere between 8 and 12% on average.
Okay. Annually.
What to do. Yeah, I mean that's kind of a a 4 point range, but I guess it depends on where we're at, what market are we at, and what's the age or type of the project. And we're looking for high teens, low 20s total ROI or IRR.
Yeah, makes sense. Right on. Well, that wraps up the first section of the podcast here. It is time to jump into the quick question round. Are you ready?
I think so.
Let's do it. It's not hard. We got this.
You gave me the
So
homework. You sent it to me ahead of time. I wish I would have. I probably could have studied more, but I think I'll do
it's
okay.
all right. It's a pop quiz then. It starts out with an easy one. This is about education. I need two recommendations. It could be any form of education, could be movies, books, whatever. But I need two of them. Give me one for general life wisdom and then one for real estate.
Um, like a medium.
No, just like a specific book that you read, a recommendation for a book, a recommendation for a podcast, a movie, or whatever. Just
Right
one
now,
for.
I'm learning about current events in business and politics. Through the All In podcast,
Oh, okay.
and that's something that I listen to on a weekly basis right now. Um,
I've heard of
probably,
the All In podcast. It's pretty good.
yeah, it's very good. And I'm not a tech guy, but it's a lot of tech talk, and that's really intriguing to me. But it also brings in a lot of business fundamental conversation, things that I can correlate to real estate and just being an entrepreneur and business owner. And then they cycle in politics and monetary theory and policy and things like that do affect my business directly. And so I find it applicable and enjoyable for sure. So that was business. The other one was
General life
personal,
wisdom.
generalized wisdom. Um, the movie or the book, The Secret.
Oh yeah. Who's the writer of that one?
I don't remember the writer, but it's about the power of the law of attraction.
Yeah. Yeah, I read that a while back. I liked it when I read it. I don't remember the author. It's gonna come to me when we're talking. Perfect. Good recommendations. Moving us on to the next question. This is for the young Gideon. Let's go back to the Gideon of what'd you say, 2005, 2003 when you graduated.
Yep.
Go back to him, look him in the eye, give him one piece of advice moving forward.
Probably find a good operations person.
That's a good piece of advice. um, I'm sure that stems from a lot of experience.
Well,
Uh,
you're a depends on the type of entrepreneur you are. I'm the entrepreneur that says yes and figures out how and jumps in. Um, and I think you have to be that in some ways. But my talent is uh, is visionary, like thinking big, putting together people and opportunities and creating deals, but that creates wake, right?
Mm.
And behind you. And so that throughput, right? We've got a great opportunity for a deal. We've got a great business plan, but are we looking towards the next deal once we close, or are we executing on that business plan? And
Yeah.
or at times during my career, I have struggled with that.
Yeah. Yeah. Finding good partnerships and matching up the correct personalities. If you're yin and you find a yang, that is ideal. So it's hard to find. It's hard to find that perfect match, but when you do, you definitely got to hold on to them for the long run. All right, next question is about the US. It is a big place. There is tons of opportunity out there. Give me the single metro you're most excited about investing in today.
Probably Dallas Fort Worth.
DFW. This has been a common theme on the past, I don't know, 10 episodes.
Really?
Like 60% of the people have said DFW. Uh,
Yeah.
I own two self-storage facilities out there. Been looking for more, but man, it is competitive. It's hard to find deals
It's
down
super
there.
competitive. Yeah. Texas is just it's not stopping. It's not stopping growing. And there's I think that it's poised for continued growth as manufacturing comes back to North America.
Ah, that you're the first person to mention that reason for growth, and that makes sense. Especially because I'm sure Texas being a very red state, I'm sure they want to bring that manufacturing to their state. And I'm sure they'll put in the right policies
Well,
to
you also have like, as we decouple from China, you still need cheap goods, right? So where are we going to get cheap goods made in North America? Maybe not completely in the US, but Mexico, maybe, right?
oh, and go
So
right there. Yeah.
I-35 runs right from Mexico up into Texas and then branches out. And so that corridor is one that we've got a keen eye on.
Interesting. Huh. That's a good insight. I like that. All right, next question is about lessons learned. We've already mentioned sometimes in a deal you will get kicked in the face, but in those opportunities you have the or in those lessons in those experiences. I'm gonna get it
Yeah,
right one of these days. This is
there are
my third
opportunities too,
podcast.
though.
Yeah, you're gonna have an opportunity to learn.
Yeah.
So what is a deal that went a little sideways, and then what was the lesson that you pulled from it?
The one of the deals that we bought early on, we bought in the Fort Wayne, Indiana market. And it was a townhouse style property, 300 plus units, really large units, but kind of in a C-class location. And we underwrote pretty large cash flows, and we didn't realize them because the resident turnover was higher than we expected just because
Mm,
of the demographic. And the expense to turn those units more frequently was higher than normal because the units were so big. And
mm.
so we didn't
Because
achieve
the
our
units
cash,
were big, and so you had more.
more square footage, more carpet, more
Yeah.
paint.
Got it.
Yeah. And we had more frequent turnover.
Yeah,
So the rent was compressed. Our rent projections were compressed, and our expense projections from a turnover perspective were increased. So it affected our bottom line.
yeah,
Um, Luckily, we were in a great market. The market saved us. We exited that property probably a little bit sooner than we had originally planned, but we won, and our investors made money, and we looked smart, even though it didn't go according to plan. But I think that being what I learned from that experience is nuance. Bigger units cost more to operate, right? And resident demographic poses unique challenges. It's not a one size fits all on every property that you're going to buy, right? So location, demographic, size of unit, and there's a bunch more, and how does that factor into this specific opportunity that we're looking into?
yeah, yeah. That's a good lesson, and I feel like it's something that people don't often talk about when you're doing a repositioning. Sometimes you have to reposition the tenant base. If you have a really poor tenant base that is, causing problems, like in mobile home parks, you'll have a certain subset of the community that is causing issues. They're just breaking rules, et cetera, and getting those people out of the property, getting good people in. That can be a nightmare. So when you're dealing with C-class properties, I feel like that is a good lesson that isn't apparent when you're getting into it, but is definitely something to learn. All right, that brings us to the last question. This is for the listeners. I'm sure people want to reach out, get in contact with you. This is a two-parter. Where can they find you? And then what can they expect when they reach out?
Yeah. So if you're interested in learning about my real estate journey from, high volume single family aggregation, transitioning over to multifamily and going large there too. We bought quite a few properties over the last 7 years, raised over $300 million from accredited investors. If you're interested in scaling up your business or getting involved in real estate investing through syndication, check me out at gshrealestate.com or investwithgideon.com. And what you can expect is some good content, some good education, and good conversation with myself and my team. So, let's start a conversation.
Awesome. I will put that link in the show notes. So if y'all want to reach out to Gideon, just click a little more in the description. It'll pull down that full description, and in there you can find Gideon's link. All right, man. That wraps it up. Thank you very much for hopping on the show.
Thanks, Gabe.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe at therealestateinvestingclub.com. If you want to support the show, just give us a review on whatever you're listening to this on. Other than that, I hope you guys have an absolutely fantastic week. Keep rocking real estate, and I look forward to seeing you on the next episode.